Welcome to Investing 101, where learning to invest does not need to be confusing or time consuming. The knowledge that we're about to go over is timeless knowledge for the most part. There's a couple updates in there with current technologies and current topics, but a lot of this is just, it's been around forever. And I want to just acknowledge that this stuff should be taught all the time, but instead what's often taught to, especially to service-driven professionals, is more about risk management and insurance. So you're more likely to be taught about investing from an insurance professional because many 403bs are run by insurance groups. And so that means that you're more likely to hear about the dangers of the stock market, and you're more likely to hear about how risky the stock market is and that you need these different insurance products. And so I want to just take a minute before we get into investing to address insurance. Now, to be clear, this advice is coming from me, that does not sell insurance. And so can be considered an unbiased opinion. And I think that's important when you're talking about insurance sales. And a lot of times these investing products and insurance products can get mixed up, and that's where it can get a little bit messy. So insurance does tend to get oversold at times. And so it's important to decide what kind of insurance do you actually need. And what you need is, if the answer to this question is yes, so could this event ruin my long-term financial plan? If the answer is yes, then yes, go ahead and buy the insurance. If the answer is no, you can self-insure. Let's talk about self-insuring in a minute. First, I want to talk about what are the four things that could ruin your financial plan. Okay, one would be a health. So having something wrong with your health, so absolutely you always need health insurance. Number two is a long-term disability. And that's why, at the very least, you should have group disability insurance. And for most other professions, you should also have an individual long-term disability insurance policy. The next one is if a death, and technically if you pass away, that's not ruining your plan, but if anyone's dependent upon you, is ruining their plan. And so you want to get insurance if anyone depends on you, life insurance. And then finally, it's lawsuits. And so that's where having adequate liability protection could come in, and umbrella insurance. So those are all examples of insurances that, I would recommend, but I'm not going to dive into in this training. And then in terms of what you should self-insure just means that you pay for it yourself, essentially. So an example of self-insuring would be, how at the airlines you get asked if you want to get insurance for your airline ticket? Well, okay, would that ruin your financial plan if you had to buy another airline ticket, like if you didn't make the trip? In most cases, the answer is no. And so you don't necessarily need to buy that kind of insurance. If it's just something small, that's an example of something you'd self-insure. And as long as you have a healthy emergency savings, then you don't necessarily need that kind of insurance. Now, keep in mind, there's always exceptions. Someone might say, "Oh, well, what if I think I'm going to cancel my plane ticket?" Okay, well then, if you read the fine print and it's okay that if you just cancel your plane ticket, you get a full refund, sure, go for it. But a lot of times that airline insurance doesn't even let you do that. It only pays out if there's some kind of crazy natural disaster, or maybe that's even the exclusion. But anyways, the point is, a lot of times you just need to consider what you don't insure. Okay. And then another general rule would be to keep your investments and your insurance separate, at least at first. So what do I mean by that? Well, I want you to avoid the pizza wrapped taco. And has anyone seen that skit? It's the Andy Samberg skit from SNL. If you haven't, after this module, go look up. It's called Taco Town from Saturday Night Live, and it's a great skit about how, maybe all you really need is a taco. Okay, maybe that's like, let's say it's life insurance. All you need is a taco, right? Just, I need some life insurance. I'm a new mom. Just, if I pass away, I need something for my kid, right? But instead of being handed the basic life insurance, it's like people are wrapping all these other things. It's like, oh, well, do you want tax-free retirement with that life insurance. and and yeah, and actually that sounds, and you're like, oh yeah, that sounds good. I'll take some tax-free retirement. But the problem is as you wrap all these different products, and by the way, that's permanent insurance. You can permanent life insurance, you can have life insurance plus tax-free retirement. Yes, it sounds great, except the problem is the fees are so high that it cuts into your investment. It cuts into it functioning as an investment, and it also means you can't buy as much insurance. And so you're not getting as much life insurance. So if you actually passed away, your kid wouldn't get as much. And so it's just by trying to combine them into something that sounds really cool, like a pizza wrap taco, it's actually, it might be better just separate. Like maybe you just have your taco one night and your pizza another night, and you'd actually be more satisfied. It's the same thing with life insurance and with investing. Now, are there exceptions to this rule? Of course. Okay. Permanent life insurance can have some excellent tax benefits, especially for ultra wealthy. If you're in the top 1%, if you're worried transferring wealth, and you're worried about the tax consequences of that, and you're like needing an estate planner to deal with all the taxes. Okay, then maybe we're starting to talk about permanent life insurance. But a lot of you that are in this class right now aren't quite there probably. So just know that at first, just try to keep those kinds of things separate. And then in general, this is just, I guess, a general thing to think about is really be aware of fees when we look at investments in general. Yeah, and then finally, the role of diversification and income streams. So with risk management, a lot of people consider risk management just insurance, but I'd like to make the case that having a really diversified investment plan and having multiple streams of income are two other ways of thinking about risk management that are just as important, if not more important, than having insurance. It's just sort of another way of being self-insured for your overall financial plan. If you lose one job, you have another. If one investment isn't doing so well, a different investment is doing well. Okay, enough about insurance. Let's dive in. Okay, this is a fun math project, math problem. All right, let's start with Sandra the Saver. Okay, Sandra the Saver, and feel free to do this math. If you have a financial calculator, pull it out. She invests 20K per year from age 30 to 40. Okay, so how many years is that? 10 years, right? Okay, and then she stops investing. And we're going to assume an 8% rate of return. And I'm guessing in that fine print, that's probably a little hard to see, but keep in mind for this whole investing section, none of this is guaranteed. There is always risk, and returns are never guaranteed. And especially in this example, they're getting an 8% rate of return every year. We're assuming, no fees. We're assuming no downsides. It's just this simple 8% compounded interest. Okay, so what is she going to have? Did you figure it out? All right, did you get almost $2 million? Okay, now let's do Pete the procrastinator. He's going to wait until 40 to start investing. And then he's going to invest 20K per year from ages 40 to 65. So notice he's starting 10 years later, but he's saving 2.5 times as long. So he's saving 25 years. She only saved 10 years, and then she just let it sit for 25 years, okay? But he's investing for 25 years. So he's putting way more money in than her, right? So if he's putting in way more money than her, 2.5 times more, what's he going to have? A lot more? No, he's not. He's going to have less. He's going to have closer to 1.5 million. Okay, and this problem, sometimes I'm still blown away by this problem. I actually just pulled out my own financial calculator just to double check it, because I'm like, because like I said, this is just wild. I think we all underestimate the power of time in compounded interest. So what is that power? Okay, so this compounded interest chart is a chart that I talk about in module 5, how it changed my thinking about investing. because wow, look at that interest earned. I mean, that's that dark green. All of that is what you call passive income. Okay, the light green is the amount that you put into the account. The dark green is interest on interest. That's what compounded interest is. Now, this chart only assumes 5.5% rate of return, 5.5% interest. That other example was 8%, just to be clear. And this is, monthly compounding. But wow, talk about a beautiful chart, right? And one thing I think to note about this chart is that, let's say, after 10 years, you're getting a decent amount of interest, right? That you haven't earned. It hasn't quite doubled. By 20 years, it pretty much has doubled. But then, wow, look at by 40 years, by 50 years. I mean, that is a lot of of money that you haven't had to work for. Okay, when people talk about passive income, this is what they're talking about. It's this chart right here. Because the only money that you had to work for is that light green. And then everything else is just compounded due to your investment. So that's pretty cool, but how do you get compounded interest? Well, there's several ways, but normally when we're talking about financial planning, some of the most basic building blocks, and I think I mentioned before that what we're talking about today we're talking about the basics. We're not trying to get crazy and creative here. Those numbers of like 8% rate of return, 5.5% rate of return, these aren't crazy cryptocurrency returns. These are just basic returns that people get with diversified portfolios, okay? So let's, what makes up a diversified portfolio? Well, first of all, we have a stock. Okay, a stock is simply ownership in a company. You own a little slice of a piece of a company. It's actually pretty cool because some of us are kind of too busy to own businesses, especially at certain points of our life. And so by investing in stocks, you get to be you get to be a business owner essentially, but you don't have to do any work. You just buy a stock. So it's pretty handy. And then bonds is kind of the opposite. You're the bank. So essentially, you're lending money out and then getting interest back, for lending that money out. And so maybe you're lending to the US government for government bonds or municipalities or corporate bonds. You're lending to corporations essentially. Okay, and then we have mutual funds or exchange traded funds. They're essentially the same thing with some minor differences, but they're a collection of investments. So, first of all, I guess the difference between a mutual fund and an ETF. Mutual funds tend to be more actively managed, but not always. There's starting to be a lot of index mutual funds. ETFs tend to be more on the index side, but again, they're also starting to be more actively managed, where it's not just the index that it's following, like the S&P 500. Maybe it's actively managed means that people are picking stocks out and deciding what to put in there and not just following an index. Historically, exchange traded funds were a little bit less expensive, but that's also changing. So these days, really the only main difference is that exchange traded funds can be traded midday, while mutual funds cannot. They trade at the end of the day. So if you're doing things like more, working with stock options or day trading, ETFs are going to be a better choice for you. You can do, inverses and just you can get more, I guess, aggressive and creative with ETFs versus mutual funds. But for a lot of you, if you're not planning to day trade, which to be clear, I am not providing enough information in this module to become a day trader. That's not the point of this module, actually. So sorry if that's what you're expecting. For most of us who are not day traders, mutual funds and ETFs function more or less the same with some subtle differences. So those were the building blocks. But then how do we earn compounded interest with risk mitigation? So we just talked about this concept of risk, and now how do we mitigate some of that risk? Because in investing, you can lose value. And that's why some people are hesitant to get in the game. Well, let's talk about that. So maybe you've heard don't put all of your eggs in one basket. Well, we're going to take it a step further and we're going to say don't put all of your eggs in one basket and then take those eggs and put them on different trucks and then take those trucks and drive them down different highways. And that is true investment diversification. And I am just now looking at this diagram and these trucks are looking kind of funny. I attempted to use AI to make this diagram and I maybe didn't. Maybe I should have given it another go, but you know what? I'm just going to roll with this. So anyways, we're going to look into the true diversification, which is all three types. Let's start with asset class diversification. This can also be seen as the type of investment. So it could be as simple as stocks versus bonds versus real estate versus cryptocurrency versus gold. Okay, but then we also can get a little bit more detailed. And I know it's probably a little hard to see all the individual words, but what I'd like you to do is look at the colors. And when you look at the colors, do any real patterns stand out? And let's say you're looking at this last one, 2023. It's this last column on the right. What pattern do you see there? Could you, for example, predict what's going to happen in 2024 based on what happened in 2023? Okay, if you said yes, that's pretty impressive because there's really not too much of a pattern that most of us can see because each year different asset classes are on top. Now, are there sort of some trends that you could pull out? Sure. And you know, this goes back to 2004, but if we like for example, if we took a different 20 years, the pattern would look different. And so in the past 20 years, for example, US stocks have done quite well. So the medium blue and the dark blue, you see a lot of that on top of this chart. But that's not necessarily going to be the case in the last 20 years. Let's zoom in a little bit and to take a look at some of the top performers of just the last few years. You can notice, like I said, now you can tell more easily the medium blue and the dark blue. That's done very well over the last 10 years, which is why a lot of people talk about, oh yeah, all you need to do is invest in the S&P 500 index and or just invest in a US full total stock market index fund. And if you look at the last 10 years, you can see why people are saying that. Because if that's all you did, you would be outperforming people with more diversified portfolios. And what's kind of hard about that is this has not always been the case. You know, it hasn't always been that the US outperforms, for example, world funds. But because it has in the last 10 years, it's kind of hard for people to sometimes get more diversified. So the problem though is that if you only are always only in US stocks, and by the way, large cap equity, that means United States large companies, where fixed income is going to be bonds. So you see that kind of those turquoise, that's the fixed income. Take a look at 2017. That there you have international outperformed the United States. And so that's an example of where you want to have, it's not saying that you should make your whole portfolio international, but having some international in your portfolio makes it more diversified and that helps with risk mitigation. So that if the US has a bad year, you have other asset classes that can help offset it. That's also another reason why a lot of people put bonds in their portfolio, even if they're young, because it also helps with rebalancing, for example, where if the stock market goes down, but your bonds stayed solid, you can actually sell some of your bonds to buy stocks low. So that's why we like to have diversification of asset classes. Next up is tax treatment. So what do you get when you combine the word the and IRS? Theirs. You're welcome for that one. Uh, okay, this is a review from Module 1. We talked about how it's really important that you're thinking about taxes not just for today, but in the future. Because many economists think that in the future we could have higher tax rates. And that's a lot of that has to do with just, you know, the country's debt and the amount of interest on the debt. And we really just shouldn't assume that taxes will never be raised again. You know, will they get this high? Probably not. But you want to be ready and you want to have a strategy. So that strategy is going to be the 3-bucket approach to tax treatment. And that's going to be pre-tax, post-tax, and capital gains tax. A lot of people already do a pretty good job at the pre-tax bucket. And that's going to be your pre-tax 401k, pre-tax 403b, pre-tax SEP IRA or IRA. Now, pre-tax means that you get a tax break today. And so that's why it's popular, because who wants to pay taxes today? Nobody, right? But the problem with that is it assumes that you're going to be in a lower tax bracket in retirement, which might be true, but it might not. That's the thing. We just don't know yet whether or not you'll be in a lower tax bracket in retirement. One, those overall tax rates could raise based on the last slide, but also, what if you have a really successful business and your income goes way up? You could actually end up in a higher tax bracket in retirement due to your business income or rental property income. And I mean, the whole idea of this financial planning is trying to get you more multiple streams of income, so you might not necessarily for sure be in a lower tax bracket in retirement. So it's not that there's zero chance that you'll be in a lower bracket, it's just that don't assume that you'll be in a lower bracket, and instead be prepared for multiple options. And that's why that next bucket, the post-tax, is the most important bucket in my opinion, because it adds predictability. So even if, let's just say, even if tax rates don't go up in the future and you're not in a higher tax bracket, then what's the worst case scenario? The worst case scenario is you've already paid the taxes. And then that compounded interest you're getting is tax free. Okay, so even if everything stayed the same, you have more purchasing power in retirement because the money that's coming out of your Roth IRA is not taxed. Okay, all the earnings coming out are not taxed as long as you access it after age 59. Where in the pre-tax bucket, everything's taxed. Your contribution is taxed and the earnings are taxed. That's a huge difference. So even if you're in a normal-ish tax bracket that's not too high, let's say 20%, still, do you want to get 100% of your pay in retirement or 80% of it? I'll take 100, right? So the more that you can put into the Roth buckets now, the better. And then one other bucket that you should address is the capital gains tax bucket. That's the non-retirement account. And we're going to talk about that more, but that's going to be really important for your short to medium term goals, I should clarify. And that one, you can take out those funds can be taken out before age 59. So pre-tax and post-tax retirement accounts are specifically for retirement. They get that special tax treatment because the government is encouraging you to save for retirement. But capital gains, because there is no special tax treatment, the good news about that is you can take it out whenever you want. The other good thing about capital gains tax is currently it's significantly less than your normal marginal tax rate that you pay when, for example, if it comes out of your 401k. Normally your marginal tax rate is going to be a lot higher than your capital gains tax rate. So good news there that you have one other option besides the pre-tax and the post-tax that adds a lot of diversity. Let's talk a little more about Roth strategies because I feel like there's a lot of misconceptions around this. One is the easiest way to get more money into the Roth, like we talked about in Module 1, is just put it into your employer plan. Just switch from pre-tax to Roth. That's probably the easiest. You don't have to open any new accounts. Maybe all you're doing is contacting human resources to make that switch. And a lot of people are unaware that they even have the Roth option because some employers only recently added them. So just ask human resources if you're unsure. Also, something new is there's now Roth SEP IRAs, where before they didn't exist. There's the direct Roth IRA, but keep in mind that if your income is too high, you cannot contribute directly to a Roth IRA. And so that's where the backdoor Roth IRA comes in. So I guess it's a little hard to see here, but in 2023, for example, if your modified adjusted gross income for married to 28K, okay, if you're making above that, you can't contribute to the Roth IRA. And then you have to do the backdoor Roth IRA. And then, yeah, single was 153K. These numbers go up every year, just keep in mind. For those of you that are above the limit for a direct Roth IRA contribution, you can do a backdoor Roth IRA contribution. And this is technically a loophole, and it's a little complicated, but I don't want you to be scared away from it just because it's a little complicated or because it's a loophole. What I do suggest is that if you're in a position to be utilizing this, maybe check with a financial planner and an accountant just to make sure it's the right thing. But how it works is if your income is too high to contribute directly, you can first make a non-deductible IRA contribution to a traditional IRA, which you're allowed to do. So it's a little nuanced in that there's phase out, like you're not allowed to take a tax deduction after a certain income level for a traditional IRA, but you can make a non-deductible contribution. And then you're also allowed to convert it. And it does not matter what your income is, you can convert any amount under any income. So basically that's how the tax loophole works. And if, again, you might want to learn a little more about it. I'm just summarizing it pretty quickly here, but reach out, and that's something that we can go over more in the mastermind group, for example, if a lot of people have backdoor Roth IRA questions. And finally, strategy 4 is a conversion. So a conversion is just one part of the backdoor Roth IRA where you're converting, from traditional to Roth. But the difference in most conversions, like for example, let's say you had an existing traditional IRA account. Well, that traditional existing IRA account, you got a tax break on originally, right? And so when you convert it, you do have to pay taxes in the year it's converted. So if you're considering a conversion to get more money into Roth, just make sure that you're in a position to pay the taxes. Otherwise, if you kind of forget that part, you're going to be hit with a huge tax bill because the amount that you convert counts as taxable income. However, with the backdoor process, you're not having to worry about that because you're not taking a tax break to begin with. All right, the third form of diversification is time diversification. And this is really important and overlooked. A lot of people mess this one up. And how it gets messed up is that the low risk and aggressive investments get reversed. And why is that a problem? Well, let's look. So basically, time horizon means how soon you need the money, and that is what should determine your risk level. Okay, and by risk level, what I mean is how aggressive is the investment. So in general, stocks, for example, are more aggressive than bonds. Can bonds still lose money? Yes, but historically, bonds, their return is a little bit lower, but they also tend to go not as negative as stocks. And so when you're in a position where you want less volatility, bonds can be a better choice over stocks in certain situations. So bonds, they're not considered no risk because, like I said, they go negative, especially bond funds in particular, but they are lower risk. And so anything that you're going to have, any investment that you need in the next 0 to 5 years should be very low risk. And that's because the stock market goes up and down. So high interest savings accounts would be great for anything in the 0 to 5 year bucket. Maybe sometimes consider CDs. Sometimes CDs can make sense. They can give a little bit of a better return than high interest savings. So it just depends on the environment that we're in, or certain bond types. Sometimes we can layer in some bonds in the 0 to 5 years, but not very often. Oftentimes it's just simpler and less risky to have a high interest savings account. Like right now they're at 5.1% to 5.5%, which is pretty good. Okay, medium risk, then that's 5 to 20 years. That's going to be a mix of stock funds and bond funds. So the 5 to 20 year investments, that's going to be things like your college savings for kids, or your sabbatical savings, which we'll discuss in Module 7, or really anything that you need in the next 5 to 20 years if you're retiring sooner. Then you're going to have to start getting from aggressive investing to at least part of your portfolio should be medium. And then finally, if you don't need the investment for 20 years, That's considered aggressive. And you want to have primarily stock funds with just a little bit of bond funds thrown in. It's also okay to throw in some real estate, some cryptocurrency. We'll talk about cryptocurrency more in a bit, but that's definitely in the aggressive category. Although I should note that in retirement accounts, it's recommended to be fairly limited at this point. From most financial advisors think it should be limited, and I'll talk about why in a minute. So a quick tip here for that high interest savings account. Hopefully a lot of you already have a high interest savings account, but if you don't, make sure that you grab one. And the online savings accounts, what they should have in common is that there's no fees, they should be FDIC insured, and there should be no minimums. And examples of this would be Ally Bank, Marcus by Goldman Sachs, or Altruist. And bankrate.com gives examples of some of the best banks that have the best rates. And so what you do is you just get one of these and then you just link it up to your savings account, and you can you can link it up to your checking account and you can just move money back and forth. Okay, review. What are the 3 forms of investment diversification? Hopefully you said tax, time, and asset class. Let's talk real quick about socially responsible investing, or ESG funds, and how that relates to diversification. Well, what you do is when we get into socially responsible investing, you can think more about the impact of your investments, which is pretty cool. And for a lot of us, it makes sense to avoid investing in, say, tobacco or firearms or companies that do a lot of pollution. And how that impacts your portfolio is you're going to end up with a loss of diversification. And so you've got to be comfortable with that diversification trade-off, because diversification is part of what makes your plan strong. But on the other hand, companies that are prioritizing socially responsible decisions tend to do better. They tend to be the companies who are more forward thinking. And so if you look at the graph over the last, since 2008, the returns are almost exactly the same. Okay? I mean, you almost can't even tell that there's 2 lines up there, right? They're so similar. And so if it's, I feel like sometimes people who are against socially responsible funds talk about how, oh, they underperform. And well, do they? I mean, it looks about the same performance. And yes, some years socially responsible will underperform a little. Other years they outperform. So it just kind of depends on the environment. You know, if oil has a really big year and you're in socially responsible funds that don't have oil or fossil fuels, then yeah, they're going to underperform. But you know, that's one of those trade-offs. In the past, the socially responsible funds had really high fees because so much research was required, and it just was time consuming. And you have a lot of time consuming research, you have to add fees in to pay the people doing the research, right? But now it's a little different. There's more socially responsible index funds. And I think the whole process with AI and with software is just getting more efficient. And so the fees aren't nearly as high as they used to be. I mean, it used to be some of the fees were 3%. I think one was even 4%, where average internal fees are more like 1%. So yeah, the fees have gotten way down. So the fees really aren't a big issue anymore. You will sometimes pay slightly higher fees on average, but again, when you look at these performances, it's not significant. So if you want to invest in socially responsible funds, there are certain platforms are better than others, and we can discuss that in the mastermind group. All right, now cryptocurrency. I told you we would talk about that. Well, I think the main question for cryptocurrency when in your investment is I want you to think about, why do you want it? Okay, is it for the getting out of traditional banks and having an outside system, decentralized finance? And do you believe in decentralized finance and blockchain? If so, then having cryptocurrency fully outside of any of your traditional investment accounts, like getting it outside of your, a Fidelity or your retirement account, would be recommended, because simply being outside of traditional financial systems could be argued that that's a type of diversification, right? Like if the whole stock market fails, but you have a Bitcoin fund instead of Bitcoin outside, then it's not the same kind of diversification. Okay. Now, are Bitcoin funds going to be tied to owning actual Bitcoins? Yes, but they're not always perfectly correlated. And there could be a situation, let's say there's some weird situation where you can't get to your Bitcoins, the real Bitcoins, but you can get to the funds, or vice versa. So just think about that as you're investing in cryptocurrency. Um, they do provide some diversification, and historically, I mean, well, as you're probably aware, a lot of cryptocurrency has drastically outperformed the stock market over the past 10 years. I mean, by like huge amounts. But, is that going to keep going? I mean, some would say yes, but that's the thing, is we don't know. In the next 10 years, will cryptocurrency outperform the stock market? Yeah, we'll see. To be determined. Okay, so I'm not going to pretend like I know more than every other financial analyst out there, because it's really just we're just guessing for the most part. And I'm sure you can find tons of opinions on this by people who are just hardcore crypto fans, but we don't know. And so because cryptocurrency is mostly unregulated, when I say we, I mean financial planners tend to use it in moderation. So in a retirement account, for example, I mean, even fans of cryptocurrency aren't going to recommend that you have more than about 5% in a retirement fund. A lot of people might say closer to 1%, they'd feel more comfortable, kind of similar to how we think about gold, um, as just a form of diversification and one more asset class. But I know some of you probably have strong opinions on cryptocurrency, and so it's often recommended that because of the volatility, that you have it as a side investment outside of retirement. That way, because there's limits on how much you can put in your retirement account each year, if you keep the cryptocurrency somewhere else, then if it continues to be extremely volatile, or if there's major issues due to regulation, at least it's not in your retirement account. One other benefit of cryptocurrency historically was that it did not have a close correlation to the stock market. Correlation means, does it move the same direction as the stock market? Because you can now buy cryptocurrency funds and put them inside of your retirement accounts, it's starting to become more correlated, which means less diversification. So just some other thoughts about cryptocurrency is just be careful with the tax implications. And then, because cryptocurrency companies were not giving out tax information before, because it was just so new and so unregulated. And if you have a lot of transactions with crypto, that has to be reported to the IRS. And sometimes you don't always know exactly how to do that because you didn't get the paperwork from the crypto firm. And then with estate planning, just keep in mind that with all of especially if you have cryptocurrency outside of the stock market and it's not a fund, it's actual cryptocurrency, um, keep in mind all those passwords and codes that you need, write them down somewhere and let someone else know. Because in many cases, if you lose that code, you've just lost your investment. In many times, there is no way to recover it. So that money could just be gone. So you've got to think of backup systems where if something happened to you, that your family or a friend or someone close to you could get to your coins. Now, what if you just want an easy way to start? The easiest way to do it is to just start with your employer plan. If you're employed, even if you're self-employed, you can get an employer plan. And you should always start by doing the minimum to get the full match. Because if you don't do the full match, then you are giving away money. And we talked a lot about all these diversification types and asset class diversification, but just start with a target date fund for when you turn 65. So if you'll turn 65 around, 2050, get the 2050 fund. And retirement date fund, target date funds are not perfect. I don't recommend them as people are approaching retirement, but if you're starting investing and it's new, it's a very easy way to start. And that's the whole idea here is I want you all to just start. And I just gave you a lot of information, but you've got to start somewhere, and this is the somewhere. A target date fund is quick and easy, and it adds diversification. It will automatically get more conservative as you approach retirement. And then, in addition to your employer plan, if you max that out, you could also consider opening a Roth IRA and a non-retirement account outside of your employer. And you can either do that yourself or you can do that with help. And then finally, just automate. Automate is key. So let's talk about DIY investing, some platforms. We have low fee trading options. I'd say Fidelity, Vanguard, TD Ameritrade, and Schwab are all options where you don't have to pay tons of platform fees and they make it relatively easy. So if you wanted to open, say, a Roth IRA or non-retirement account on your own, these are some great options. And while you can eventually learn more about investing, right now the target date fund is just simple. And one thing to keep in mind is, let's say you're at Vanguard. The one problem with investing in a place like Vanguard is you are incentivized to go into Vanguard funds. And so, same thing with Fidelity. Fidelity has some free funds, but are the free funds really free? It's encouraging you to come to Fidelity, but then not all of their funds will be free. But, I'd still, even with the fact that not all of Fidelity's funds are free, Fidelity is still a great example of somewhere you can start that has at least relatively low fees. Another somewhat DIY option is to invest with a Roboadvisor. So what is this? Well, robo-advisors are just automated ways of investing where you have a team of investors who make model portfolios, and then anyone can go in and buy into those model portfolios based on their age and risk assessment. And so it's going to be somewhat generic because, the models are just made for the masses, but that's okay. You don't necessarily need complicated custom investing. Most of us are fine with these models. The fees are about 0.25%, which that's going to be more than doing it yourself. You get the fees down close to zero, or maybe close to like 0.05 if you're doing it yourself. But for 0.25, the good thing about it is it's easy. Because someone is trading for you, you don't have to think about, oh, I'm not supposed to have a target date retirement fund as I get close to retirement. And so here you're in actual funds and ETFs. You're not just in a target date retirement fund. So that's good there. Betterment and Wealthfront are both examples of well-known and good robo-advisors. And I think they both have fees around 0.25%. And then the main bad thing about robo-advisors is, even though the word advisor is in the title, you don't have access to any kind of comprehensive advice or individualized advice. Some of them have call centers you can call into, but it's just not going to be anything where they actually know your situation or your values. Earlier I said automate it, but I really want to talk about that one more time because automation is key to success in financial planning. As we noted with compounded interest, time is our friend. Time is the key factor that allows compounded interest to provide passive income. It's the absolute key. And so procrastination gets in the way of time working in your favor. And we all procrastinate. And so automation is the antidote to procrastination. So it's something that's very simple. It's probably one of the easiest things you can do, but people just don't always do it. And that's where we get the concept of pay yourself first, is that you just want to have money pulled out for retirement or for your investments before you get to other things. So set those contributions. You can also set auto increases. You can automate everything so that you just don't have to think about it. And you want to do this as soon as possible. But if you're like many people, like the couple more days construction skit, if you've seen those, there's always a couple more days. You know, if you're in a project, there's always going to be something else. It's just never quite done. And if that's how you operate, then you know you might not want to do it yourself. And so if you decide to get help, uh, the person that you get help with should be independent. That means they don't sell any of their own products. They should also be fee only. That means actually they don't sell any products at all. Uh, CFP stands for Certified Financial Planner. AIF is Accredited Investment Fiduciary. Both of these will be examples of fiduciaries, which means they act in your best interest. And then in a perfect world, you also wouldn't pay an advisor fee for management. Okay, so this is not super common. Most advisors do charge an advisor fee, but this is what we did with Equal Path. So yes, this is a self-promotion. But if you want help, we're all of these things. And if you end up not going with us, just go with someone else that has these features. You made it. Okay, nice work. That was a long module. Lots of different things you could start with. For the end of the day, I would think something related to automation. That's got to be your first step. By end of the week, maybe something related to researching what kind of account you need to open or who you open it with. And then by the end of the month, maybe you're making your first contribution. So there you go. Let me know if you have questions and reach out in the community group and the mastermind group.